I start this presentation with basically looking at what is this new Companies Bill about. In fact, the Companies Bill has just been passed by both the Houses of Parliament, and as of date, it awaits the assent of the President. Normally, as per the procedure of the legislation, normally all these legislation go to the President after the House is prorogued, and then the President gives the assent. Thereafter, it will be notified as an act. And curiously, this Companies Bill consists of a lot of provisions. Even if the act comes into force, many of the sections would require notification separately of rules to govern the respective provisions. Some of these we will look at as we go along this presentation. So this was passed in Lok Sabha on 18th December 2012. Then it went to the Rajya Sabha and it got passed on 8th August 2003 after a 7-year deliberation. And in fact, the debate in Rajya Sabha was really good, and we had a lot of good speakers making a lot of points, and some of those points we will touch upon as we move along this presentation. Now basically the presentation will be in this format. I'll just have a brief touch on the history of Companies Bill and the company law legislation as such in India. And what is the main focus of this Companies Bill? What I find that these are the major areas which the Companies Bill has sought to address, and as compared to the earlier legislation. Then what is the structure of the Act? Then what are the new concepts? Though there are many, we will touch upon some of them. And then some of the new definitions that have come in. Then what are the important highlights of respective topics, and then we will have a topic-wise overview. But our focus would necessarily be more on the audit and accounts, since I come from that profession. Many of the topics related to accounts and audit will get more emphasis on that. And then we'll see some of the new today's news. A committee was formed post-independence in 1950 to redraft the company law. And the Companies Act was legislated in 1956. In fact, one of my professors used to jovially say that the English Companies Act 1948 became the Indian Companies Act 1956, and it took 8 years for us to copy it. Most of the legislation of 1956 was drawn from the English Companies Act 1948. The English Companies Act got revised again in 1985, but we didn't have it revised. We continue to get it amended, and at least in my living memory, at least twice we attempted to get a new Companies Act in 1988 as well as in 1993. Both the times, before the law could be passed, the Parliament was dissolved. So in 1956 to 2012, we have had 24 amendments, out of which the 4 amendments were very major. This happened in 1965. The highlight of that amendment was the segregation of objects class into main objects and ancillary, incidental and other objects. Now, curiously, in the new Companies Act, we are going back to the pre-1965 era. Then 1974, we had the amendment relating to 43A and the managerial remuneration, all those things. And 1988, we had the new CARO and again some amendment relating to managerial remuneration. 2000, we had a comprehensive amendment on many aspects, including some on deposits, this red herring prospectus, and then we had the disqualification of directors on certain issues, and accounting standards came into the Companies Act in that year. Then in 2004, a concept paper was prepared to completely redraft the law, and the concept paper and then the recommendations of J.J. Irani committee. Both were considered, and a new companies bill was drafted and introduced in the Lok Sabha in 2008. Before it could be taken into consideration, the term of the Lok Sabha ended and it got lapsed. In 2009, the companies bill was reintroduced into the Lok Sabha, and then it went to the Standing Committee on Finance. We have an excellent report of the Standing Committee on Finance on this company's bill, which consisted of a lot of suggestions, many of which have been taken care in the revised bill that was presented in 2010. Some of them still remains, and they remain unaddressed. Then 2011, the revised companies bill incorporating the recommendations of the SCF was introduced in the Lok Sabha and was again referred to the Standing Committee on Finance, which again went through it, and the report along with the bill was laid in Parliament, and the final version was passed on in December 2012, and again on 8th August 2013 in the Rajya Sabha. Now the bill goes to the President for assent, and we await the next few steps, and we are now almost near the New Companies Act. As compared to the earlier period when the two bills got jinxed, we were always thinking that Companies Bill will never see the light of the day, and I think we see now the light at the end of the tunnel. What are the major focus which we can see or perceive from the amendments, and some of these flow through the objective as narrated in the Standing Committee report of 2009. These are: one is simplification of law and procedures. Simplification, we can say that at least in the number of sections it has come down drastically. It is cut by 1/3 at least. And then procedures, many of the requirements of seeking central government permissions are done away with, but we do not know whether they are done away with for good, because we may have situations where the rules may prescribe that some of these would require government permission. So we need to closely look at what is the rule that is going to be prescribed for each of the various provisions for which they have been given for delegated legislation. Then the next is the importance to self-regulation. A lot of committee mechanism have been recommended in the Act, and that is going to come in, which could improve the self-regulation of companies, like the remuneration committee, and then benchmarking with the low-paid employees with the high-paid executives. So all these things would lead to self-regulation. Then CSR is one major new addition to the Companies Bill, about which my colleague speaker will be elaborating. And then the corporate governance and stricter enforcement of law. We are now looking at the penalties getting multiplied, and then the threat of prison terms being increased in the new law, and also the enforcement of law. The long arm of law is not going to leave the auditor or the secretary away. So the law is empowered to even search and seize records in an auditor's office or in secretary's office. So that way it is facilitating stricter enforcement of law. And then investor protection, including small shareholders, are being considered in the bill. Now, this bill is divided into 29 chapters spread over 470 clauses and 7 schedules. Some of the schedules have been redrafted, some of the schedules have been renumbered. There are previously we used to have 14 schedules, now it is reduced to 7 schedules, because some of the things which are covered by schedules now are going to go as rules in the new law. There are about 33 new definitions, some of which we will just see and touch upon them. Substantial part of the law is in the form of rules which will be prescribed separately. This paves the way for the department to administer the law on many aspects without prior sanction of Parliament through the mechanism of delegated legislation. This is one area which is being seriously contested by the various committees of parliament. In every report, they say that so much of whether so much of law should be left in the hands of the executive. Then at this time, I am reminded of the quote from Herbert Hoover, who was the president of US, who said, if law is to be upheld by government officials, then that is the end of law. If law is to be upheld only by the government executives, then I think it requires a serious rethink. So many, even some of the, say for example, the law related, even the authority like the National Financial Reporting Authority, which is going to come up, about which we'll be seeing in the later stage, will be the judicial power to administer justice in relation to disputes on audit and accounts, which will be manned by not only the professionals but will also have government representatives of the executive. Whether that is a good, healthy practice, that is things which we have to see in future. Then these are some of the new concepts that have come out. One is the one-person company. This is a newer thing for India, where a company can be formed as a one-person company, and it can be designated so. It will have all the benefits of limited liability and other things, but it can continue to have only one person as member. There are restrictions on some of the areas in which they can operate, on how they can operate, but otherwise it is not required that you should need two persons and look for other signature to form a new company. So this is one. In the concept of independent director is sought to be more forcefully brought into the Act, and in fact there is a new definition for independent director, though the definition is not very clear. We will have to look for some of the rules that will be prescribed in relation thereto. Then the requirement of women director. In certain class of companies, the government is empowered to notify that they should have at least one women director. But whether that woman director should be independent or can be a promoter, it is not, the Act doesn't prescribe that. Maybe the rules could prescribe that way, that the woman director could be independent. Otherwise, if it is just going to be the legal compliance, we will see, we may see the promoter himself nominating one of the women from their own family or something. So then next is class action rights are new concept, though if we see the existing law relating to oppression and mismanagement, the class action is slightly hinted there, but it is not explicit. Now the class action rights are explicit in the same chapter of oppression and mismanagement. This is again, it is not an individual shareholder who can raise his issue. The old rule of Foss versus Harbottle remains, but still some group of shareholders or group of deposit holders can exercise their common rights to get benefit. Some of the rights, the rights narrated in this section includes the right against the auditor and other professionals. And in fact, in respect of auditor, for misstatements or improper statement in the accounts, the shareholders or deposit holders can sue the auditor under this. Though the current operation and mismanagement is only against the management, here some of the experts and other outside professionals are also sought to be covered by this class action rights. Then there is this treasury stock, that is when the shares are brought by a trust in the case of an amalgamation where some dissentient shareholders can sell the stock. So it can be held as a stock by the trust, by the company itself, and then it can be sold to other shareholders. Then there is the corporate social responsibility. This is a new concept. Then you have the registered valuer, is a new concept that has been brought into the Companies Act, wherever valuation is required under the company law. like an amalgamation or a restructuring or reduction of capital, wherever it is, if the shares are to be, even in the case of a dissentient shareholders being brought out, wherever valuation is required, the valuation has to be done by a registered valuer who will be registered under this act. Now the qualifications and other things are yet to be prescribed, and these we expect some notification. Then the concept of private placement is now recognized by the law. Now there is a legal mechanism to administer or to implement the private placement. In fact, some of the provision relating to prospectus will apply for private placement. So this is more to attract the foreign investors who can come through the route of private equity funds or through FIIs, where any private placement is by qualified institutional buyers. They can also come under this private placement preceding a public issue. Then holding and subsidiary accounts are sought to be merged. That is the merger. This is relating to holding and subsidiary merger, which it is now a easier route, and no court intervention is required if a wholly owned subsidiary seeks to merge with a holding company. Then associate is a new term that is brought into the act, though in a way in the earlier Companies Act through the accounting standard associates are recognized, but here there is a definition of associates, and for some of the sections associate is considered as a subsidiary. Then rotation of auditors is a new concept that has come in, and this we will see in detail when we go into the some of the provisions. Then dormant company, this is a new concept that has come in. This is in relation to companies which hold only assets, which hold assets as a and no other activity is done, like holding of intellectual property, like holding of the trademark, like holding of certain big intangible tangible assets, also like properties in certain places which are not meant for trading or for business use. So such companies can register themselves as dormant company and need not comply with many provisions of the Companies Act. There are some new definitions that have been brought into the Companies Bill which are very significant. Are accounting standards is sought to be defined, then auditing standards are defined, then there is the associate company definition. Now CEO, CFO are sought to be defined, but if you see the definition, it says a CEO is one person who is treated as such. But if how a CEO is to be appointed and how he is to be named as such, all these things are left for future rules that are to be made. And CFO in the same way. These two are sought to be defined more to treat them as a key managerial personnel. Then control is sought to be defined. Now the definition of control is quite wide, and the interpretation requires a lot of deliberation. It could be that in one way one company could control the other, and the other company could control the same company, the company which is sought to be controlled. So these two aspects have to be, there is a dilemma when it comes to consolidation, all these things. So these we'll have to see for the law to evolve by rules, and we'll have to see how this is going to be administered. Financial statements is a new definition that comes in. In many cases, instead of balance sheet and profit and loss account, the statement financial, the term financial statements is used. Financial statements includes balance sheet, profit and loss account, and cash flow statement. In one other provision, they also include the statement of changes in equity. Then independent director is also defined in the Act. One of the some of the definition of independent, some of the clauses relating to definition of independent director requires a lot of deliberation on whether a person will be considered independent even if he is elected only by a promoter. For example, if a company has 90% shareholding by a promoter, now how such a director can be independent by saying that he is a professional or he is a person who is not related to promoter, but he has to be completely dependent on the voting by the promoter. So we do not know, maybe some mechanism to protect the independence of such independent directors will come in the rules that are to be made in the new section. Then key managerial personnel, there is a definition for key managerial personnel, listing out who are all considered as key managerial personnel. As is usual in many cases, here also the last clause says that any other person that may be notified or prescribed by the government. Then promoter is sought to be defined. When I see a definition of promoter in law, I am reminded of the famous words of Bowen in an English case where he said promoter is a term not of law but of business. But here promoter is sought to be brought into the law. Now, one person company is also defined here, and I think we briefly saw that. Then small company is sought to be defined. I think already we have a thing called small company under companies accounting standard rules. Now a variant of that has been brought into the companies bill. Now some of the important highlights where we look at is the maximum number of members for private companies are increased from 50 to 200. Then substantial additional information is to be given in annual return. This includes some financial information, some promoter related information, some related party transactions that are sought to be brought into the annual return. Then all companies have to follow the financial year as April to March. The only companies which require a different year have to approach the National Company Law Tribunal to take permission to follow a different year. Now every company has to follow its accounting year for the purpose of Companies Act as April to March. Now the definition of related party is being widened. That is, they are also including for the definition earlier was for relatives, now it is for related party. So naturally many companies and firms that are getting into this definition. Provision relating to charitable objects of companies, existing section 25 companies are enlarged. We'll see some more of that in the next slide also. Special provisions for private placement. Then rotation of auditors and audit firm has been introduced. Standards on auditing are also given a statutory backing like accounting standards. Now search and seizure powers extended to the premises of auditors and company secretaries. Now if in the case of an investigation by the government under the powers of inspection, if they feel that there could be some matters that are available at the auditor's office or at the company secretary's office, they are empowered to search the premises and seize the relevant documents. Now transfer to reserve, that was a precondition for declaration of dividend, now it has been made voluntary. There is no compulsion on that. Fast track mergers without court process. Some of the mergers like the holding company, subsidiary companies are all through fast track mergers which can happen without a court process. Constitution of Company Law Tribunal. Now Company Law Tribunal, though it was brought into Companies Act, it has never been implemented. Now they have enlarged the role of National Company Law Tribunal and enlarged the number of members of the National Company Law Tribunal as well. In fact, even the chairman has been fixed the qualification of 5 years as a High Court judge, as against the earlier provision in the current Companies Act that he should be qualified to be a High Court judge. Certain companies to constitute Corporate Social Responsibility Committee. Now let us go to the topic wise. Now let us see some of the issues relating to basics and formation. One-person company and dormant company has been introduced with minimal regulatory compliance. This could be of great use to companies or this could be of great use for firms and sole proprietary entities which are huge businesses but which want to take the advantage of corporate form. So those entities can now migrate to one-person company in a way, and companies which are holding huge intangible assets, they can shift their assets to a different company and hold those assets for hold those trademarks and intellectual property rights for perpetual succession by having a separate company, which can remain dormant without any activity, but which can remain for holding company is prohibited to make investment in shares of subsidiary company through more than 2 layers of investment companies with certain exceptions. Now this is going to be a huge issue among companies with diversified business portfolios, because normally companies with diversified business portfolios have 2-3 layers of investment companies, like more than 2 layers of investment companies. There are companies which have different investors for different industry, and they have minority investors who will have specific interest in, say, an insurance partner would not like to enter into a bank. A banking partner would not like to enter into a NBFC. So there are many companies which are having diversified portfolios controlled under a common group, but having different minority investors at various levels. Now, how do they manage this issue is going to be a challenge. I don't know how this will evolve. Then S12 section 25 has been replaced by clause 8 with expanded object clause to include sports, education, research, social welfare and environment protection. Previously, normally section 25 companies were effectively trade associations. We had a lot of trade associations registered as section 25. Now the government wants to enlarge the scope of section 25 companies to cover sports, education, research, social welfare and environment protection. But one other amendment that has come, one other change that has come as compared to the earlier Companies Act is that, see, clause 8 now, that is the new section 25 variant, explicitly prohibits the payment of dividend to members. Now, though in the earlier section also, section 25, if we are to get tax exemption, they were to specifically prohibit payment of dividend in their articles. Those section 25 companies which are ready to pay tax were entitled to declare dividend to its members. But now clause 8 specifically prohibits dividend, but existing section 25 companies which are already registered with income tax for tax exemption may find it not very different from what is proposed to be done. Clause 8 companies and other companies licensed by central government may drop the words limited or private limited from its name by obtaining approval from central government. So basically the clause 8 companies are allowed to drop their word limited, though they may be limited. But I do not know, there could be some rule which could say that somewhere a disclaimer should clearly state that the liabilities of the members are limited. Otherwise, if it is not mentioned, people can say that it is an unlimited liability company. So there could be some more rules on this to fortify the investors from claims. Then subsidiary of non-private company is deemed as public company. Even though the some recent changes have brought in this, but here it is more explicit and quite clear that once it is a subsidiary of a non-private company, even though it may be a private company or a one-person company or a dormant company, it will be deemed as public company. Then memorandum of association to contain only the main and ancillary objects of the company. Company cannot provide for other objects clause. I think this is in a way moving back to pre-1965 era, when we had only one omnibus clause of objects, where we combined main and ancillary and other objects. Now they have said that you can have main and ancillary, but you can't have another objects. So naturally the construct would be that foresee all the objects that your company could take and put it in the main objects. Then public offer and private placement is clearly distinguished. This is another thing. Now private placement was never recognized in the Companies Act explicitly, though in a way the section 81, the current section 81 relating to rights issue of shares, which requires in the case of public companies to clearly state, to clearly pass a resolution allowing the company to issue shares to others. And in the case of private companies, it was contained in the articles relating to allotment of shares to other than the existing shareholders. Now private placement is also sought to be governed by a new chapter. It is part of the prospectus, and here they have distinguished two things. One is the public offer and the private placement. There is a prospectus type of document which has to be given in the case of a private placement. Naturally that has to be filed with the government, maybe the registrar of companies, and that document has the same validity as a prospectus, and all the attendant provisions and rigors related to prospectus will apply for that. So if a prospectus like document is filed with a private placement fund or a private equity fund or anything, then they will get all the rights that are available for a shareholder who invests on after seeing a prospectus. Now the good question is whether such a issue of prospectus will reduce the rigors of due diligence, and will it cut the timeline of the timeline between equity fund, timeline between a term sheet and actual receipt of funding by a private placement. So maybe this could trigger that event, and we may see that fundings happening at a faster rate and in a slower time frame, in a smaller time frame. Then in private placement mode, company can invite or make an offer to a maximum of 50%. Beyond 50%, it will be considered as a public issue, and naturally the entire rigors of prospectus will apply, and SEBI listing and other things would be required. Any variation in terms of contract, this is a new provision relating to prospectus. This is applicable equally for private placement as well. That any variation in terms of contract mentioned in the prospectus or any variation to the objects clause is possible only after giving an opportunity for exit to dissenting shareholders. Say for example, if a promoter has entered into a contract with the company and this contract is mentioned in the prospectus. Now if that contract is sought to be varied, then if any shareholder dissents, the shareholder will have the rights, right to ask the promoter to buy out the share, ask the company to buy out the share, and if the company buys out the share, that the company can hold it as a treasury stock, in a trust. Now here comes the issue of valuation, and if there is a requirement of valuation, then that valuation has to be done by the registered value. Then in the prospectus, whoever is identified in the prospectus as expert and whose opinions are there in the prospectus, are published in the prospectus, they are liable for misstatements. Currently the misstatements liability are restricted to the management or the directors who are named in the prospectus as persons responsible for the prospectus. But in a different way, we used to derive this liability by saying that the management can sue the management can say that they relied on the expert and the expert can be hauled up. But here there is an explicit clause It says that the experts whose opinions are included in the prospectus, they are liable for misstatements. Now, concept of deemed prospectus has been introduced with reference to offer for sale by a trust, underwriter or other members. Where as we have seen that a trust could buy the shares where there is a either a dissenting shareholders are selling it, or in some other situation a private funding happens through a trust, or the underwriter has bought the shares and he and the underwriter or the trust wants to hold the shares and thereafter issue it to public. Then whenever they issue it to the public, there is a deemed prospectus which it has to be published or which has to be filed with the government. Then there is the global depository receipts have been defined. Then shares cannot be issued at a discount. Now there is a specific provision in the current Companies Act which has been done away with. Except for sweat equity shares and in a limited extent could happen in an ESOP, there cannot be any issue of shares at a discount. Annual return requires disclosure of significant additional non-financial information. I think some of these we discussed earlier. Mandatory observance of secretarial standards as regards general meeting and board meeting. Now, secretarial standards also form part of the Companies Act. Then voting by electronic means are being brought in. So minority shareholders, any small shareholder need not attend the meeting, they can vote the resolution. Matters requiring special resolution have been enhanced. Now, on accounts and audit, we have the restriction on interim dividend if the company has incurred loss in current year. There is if there are monetary, there is a ceiling that is sought to be made for an interim dividend where the company in the current year has incurred loss and has to restrict its dividend to a particular level. Then transfer to reserves as a precondition for declaration dividend is not mandatory. An unpaid dividend is transferred to investor protection fund after 7 years. Related shares also need to be transferred to the fund. Then company cannot pay dividend if it has committed a default in relation to raising of deposits from members and public. Then the bill provides for refund of money to the eligible person. Currently, the whatever money is paid into the investor education and protection fund cannot be refunded, but now the bill provides for refund of money wherever the eligible person, as it was happening prior to the formation of the investor education and protection fund. In the earlier period, after 3 years, these were transferred to general revenue account. There was a form which could be filled by a genuine claimant and lodged with the central government, and then the respective shareholders could get the money back in the earlier period. After the formation of the Investor Education and Protection Fund, this was curtailed, and now again the bill restores that pre-1998 position. The discretion of central government with respect to payment of dividend without charging depreciation is dispensed with. Though this is only academic, I have never seen in my career any company which has paid dividend without charging depreciation with the central government sanction. Now that is in the rule, it was there in the legislation, now it is done away. Then financial statements and books of accounts, companies to follow uniform accounting period, we have seen that. Then statement of changes in equity and cash flow statement to form part of financial statements. Currently cash flow statement is applicable only for certain companies. Now it is applicable across the board. Every company has to have cash flow statement along with its balance sheet and profit and loss account. And in some of the companies you will also have to have statement of changes in equity. Then books of accounts may be maintained electronically, and this is also allowed, explicitly allowed. Then depreciation on assets are to be reckoned on the basis of useful life as against the rates, though the current rates are derived based on useful life. Then consolidated financial statement getting recognized for the first time in the Act. Previously it was only in the standards it was given, and SEBI had mandated it. Now it is part of the Companies Act, and every company having subsidiaries or associates have to provide consolidated financial statements. Then substantial changes have been made in relation to audit. First auditor shall hold office till the conclusion of the first AGM as presently. Then auditor appointed at the first AGM can hold office till the conclusion of the 6th AGM, and thereafter till the conclusion of every 6th AGM. In case of casual vacancy, newly appointed auditor shall hold office till the conclusion of next AGM. Then compulsory rotation of individual auditor in every 5 years of the audit firm, and in case of audit firm, every 10 years. If it's a sole proprietary auditor, he can hold office only for 5 years, and if it's a firm, he can hold office for 10 years. Though partner rotation is not explicitly given, but power to do that has been vested, and we await some notification and more clarity on this. When does the period of rotation start also is subject to the notification that is going to come out. In the case of audit firm, the incumbent audit firm shall not have any common partners with retiring firm. Transition period for the companies to comply with the provisions of rotation of auditors is 3 years. Now, where from this 3 years is to be reckoned, we'll have to wait for the notification. The company as well as the auditor have the right to terminate their engagement before the expiry of the term. Removal of statutory auditor requires special resolution and approval from central government. Currently, it is general normal resolution and central government sanction. Now it is going to be special resolution and approval from central government. Liability of individual auditor extends to audit firm also. Now, if any individual auditor is caught for misstatement, the firm also could be sued if he is a partner of that firm. Only chartered accountants are eligible to be appointed as auditors. Chartered accountant providing certain restricted services shall not be appointed as an auditor. Even if services are provided indirectly, disqualification is subtracted. Not to be an auditor in more than 20 companies. Remuneration of auditor shall be fixed in general meeting. Remuneration includes all amount paid in connection with the assignment, including reimbursement of expenses. However, payment for specific services requested by company is excluded from the purview. Now, duties of auditors and other matters. In this, auditor has additional matters on which he has to make inquiries. Now, auditor also has a right, or you can say it's a duty as a whistleblower. Now, auditor is bound to report directly to the central government where he comes across any fraud committed against the company by its officers or employees. And here there is a clause under the Act, which in the new law, which says that if he acts as a whistleblower and it is found, subsequently it is found that that was not a true case, or it was not as suspected or as grave as suspected, then the auditor is protected if he has done this in good faith. So there is a protection, and an auditor cannot be sued on that ground by the company. Compliance with standards on auditing is mandated in the bill. The National Financial Reporting Authority can also debar a chartered accountant from his membership, apart from the institute, and also the company law tribunal can do that. Secretarial auditor to be appointed by every listed company and other prescribed companies. The current NACAS is renamed as National Financial Reporting Authority, with enlarged power of setting audit standards and investigating professional misconduct by chartered accountants. Other matters. Concept of class action suit has been introduced. This I think we discussed briefly, and the other things are compulsory CSR contribution that is brought in. Then board meeting can be conducted through video conferencing. Though even now it is permitted, but for reckoning the quorum and the members present, people joining through video conference are not considered as part of the meeting, though their views can be recorded in the minutes. But in the new law, board meeting can be conducted through video conferencing. Board meeting at shorter notice can be held, but at least one independent director should be there, even though the others could constitute a quorum. Restricted intercorporate loans and investments through more than 2-layer investment subsidiaries. This also we have seen already. Key managerial personnel cannot hold office in more than one company at the same time except in subsidiaries. Certain related party transactions require approval by special resolution in which related members are not entitled to vote. This is now applicable even for a private limited company. In the case of board meeting, interested directors cannot participate even in a private limited company, which is current law. It is not there. Separation of office of chairman and CEO. 1/3 of board of directors of a listed company shall be independent directors. Provision for women directors introduced with respect to prescribed class companies. As we have already seen, women directors need not, they have not very clearly said that whether that should be independent or not. Representation of small shareholders in the board of listed companies. Upper limit of directorship in companies is increased to 20 with a sublimit of maximum 10 directorship in public companies. Since earlier we were not reckoning private companies, now private companies also are brought in. No central government approval is required for appointment of any director or any other person to any office or place of profit in the company. That is, section 314 is done away with. Person sentenced for a period of 7 years or more for any offence disqualified to be a company director. Today we saw two news items which may be of interest. One is the interview with the Minister for Company Affairs. Here he says that the framing of rules, he can't set a time frame, not even say 6 months. So we do not know when it could be coming out. And the other is an interview with a chartered accountant who is a who is the chairman of the company law committee, ICII, Mr. Santana Krishnan. Here he has referred to the enlargement of the scope and responsibilities of the auditor. So this is one thing I think we have to deliberate when we, as the law evolves and how it gets notified. And there are two ways to look at it. One is either the professionals will be responsibilities having been enlarged so much by the Act, the rules may give some liberal thought about it, or it could be rules may take direction from the law and make it more rigorous. So let us keep our fingers crossed for the professionals, and even some of the independent directors also are sought to be covered by many of these provisions, whatever is applicable to the auditors and secretaries. So these are the things. I await interaction for the questions, and now I hand over the floor to Mr. Vaidishwaran for his presentation on corporate social responsibility.
Good evening. That was an in-depth analysis by Sundaram. Now, yesterday most of you have seen the Lok Sabha live, where the food bill was passed, and there was a lively session till the almost end of the night, where the Lok Sabha went through the food bill. And you would have seen how the amendments were debated and how it went through. Now, what has happened as far as company law is concerned is going to be interesting, because the legislation is through, at least as far as the Lok Sabha and Rajya Sabha is concerned, and it awaits the assent of the President. But significant decision-making power has been delegated to the rule-making authority. This trend is probably slowly catching on. We saw it in FEMA earlier. FEMA came up with a broad framework of what constitutes the foreign exchange policy, but regulations were delegated, and today we have changes in FEMA through just a circular. So a circular by RBI can bring down from $200,000 to $75,000. So that level of delegated power in a legislation which is of significance like corporate law can make the law a little bit unstable, for the simple reason there's nothing to fault the delegated power, but the delegated power has the tendency to be exercised quite often. And you will soon have rules which keep on changing. So the level of knowledge which is required for the corporate as well as for the professional advice in the corporate is going to be very, very significant, and looking at reasonably knowledge testing times. Now let me look at one segment of this particular new law called CSR, Corporate Social Responsibility. If you look at the background, it's not as if it is quite new that companies look at social projects and charitable projects. Most companies have been spending significant money on charitable activities and social activities without there being a mandate. In fact, it is out of their own interest that they contribute to the local area in which they are located. There is no mandatory requirement, but people have been spending. But if you look at the Constitution, interestingly, under Article 38(2) of the Constitution dealing with directive principle of state policy, the state has to strive to minimize inequalities of income, eliminate inequalities in status, facilities, opportunities among individuals as well as group of people. So it is basically the state's responsibility, which is probably slowly getting passed on to the corporate sector in some form. Companies to set aside at least 2% of total profits for CSR. And if you don't do so, the reasons will have to be stated very clearly in your statements. And how does this whole process of CSR go through? Look at the eligibility. If you're a company where your net worth is more than 500 crores or more, or if your turnover is 1,000 crores or more, or your net profit is 5 crores or more, it's a very small number, during any financial year, then you should immediately constitute what is known as a Corporate Social Responsibility Committee, CSR committee, which has to consist of more than 3 or more directors, of which at least one director shall be an independent director. So the first discovery process should be that you discover that you have only 2 directors today, and you'll have to expand your board for the sake of creating a CSR committee. So in many cases, there are not more than 2 directors sitting on the board, so they will have to have one person concept. So with the 5 crore as a profit, first of all, you'll have to expand your board, and then looking at create a CSR committee, at least one should be an independent director. And your board report must disclose the composition of the CSR committee. The functions of the committee: formulate and recommend to the board a CSR policy indicating the activities to be undertaken by the company as specified in Schedule 7. Number of schedules are minimized as pointed out by the earlier speaker. This is the last schedule. Recommend expenditure to be incurred on the activities referred to in Clause A, and monitor the CSR policy of the company from time to time. Now, what's the role of the board? The board has to consider the recommendation of the CSR committee, approve the CSR policy, disclose the contents of the policy in its report, and then the company has to place the contents of the policy in the company's website in the prescribed manner. Throughout the company's bill, you will find the word prescribed. The moment the term prescribed is there, it means that rules are going to follow. So prescribed would mean that there will be some sort of rules. So for example, you'll have CSR implementation rules, CSR committee constitution rules, all kinds of rules. So when Ramaya is going to come out with a new book, it's going to be a very voluminous book, because it's the type of rules that are going to come, and it's going to be a big challenge to keep on updating that edition. Board has to ensure that the activities undertaken by the company are completely carried out as per the policy, and the company spends in every financial year at least 2% of the average net profits made during the 3 immediately preceding financial years. Now, all this is contingent upon when the law is going to come into force. So we have the bill, which is at the Rajya Sabha state to become, so to say, passed by the Rajya Sabha. After the president gives his assent, there has to be effective date, and then the rules have to be given as a draft rules, approved and notified. So when the law comes into force is a critical point to then take into account what constitutes immediately preceding financial years for pursuance of CSR policy. Average net profits during the 3 immediately preceding financial years. One advantage is that the company can give preference to the local area and areas around it which it operates for spending the amount earmarked for CSR activities. And as I said earlier, in case there is a failure to spend such amount, the board shall have to make a declaration under section 134(3)(o) specifying reasons for not spending the amount. Now, typically what they've said, a very interesting provision called section 198, which says what all should be taken into account and what all should not be taken into account in the profits. For example, they say that bounties and subsidies received from the government or any public authority constituted or authorized on this behalf by any government should be credited, which means it's part of the profits. If you receive some money from the government by way of subsidy or some bounty, that is also considered as part of profit for the purpose of this calculation of eligibility as well as spending on CSR. But when it comes to other transactions which are quite obvious, these are all transactions which do not have that characteristics of a profit. They, for example, share premium or sale of forfeited shares, or when you sell off an undertaking, a slump sale happens in the company, whatever capital profits that are got from that, or if you sell off immovable property, or there is a revaluation related surplus, those things will not be taken into account as far as your credit is concerned. Interestingly, when it comes to deductions, They talk about all your usual working charges. You can deduct your director's remuneration, bonus or commission, etc., etc., etc. Almost every business expenditure is covered, but my worry is this. The following sums shall not be deducted. Income tax and surtax, surtax doesn't exist, but income tax and surtax payable by the company under Income Tax Act or any other tax on income of the company does not qualify for a deduction, which means your profit and loss will be computed in accordance with the Companies Act. You will get your deduction under the P&L account for IT as far as your basic determination of profit. But for the purpose of calculation of profit for CSR, the IT will not be allowed as a deduction. It's a very strange requirement. In other words, it indirectly increases the income tax outflow in that sense. And your CSR is, a mandatory payment, and any mandatory payment today is viewed as a tax. So I'll come to that part later. But this is a very serious point where they say income tax would not be allowed as a deduction. You can understand capital profits and capital losses, but this is quite strange as to why they're talking about this. Interestingly, income tax is the money which a company pays, which goes to the central government's coffers and comes back as welfare schemes. So you have already made your CSR contribution when you pay 33% income tax. So as a company, if you have already made CSR payment, I don't know why it should not be taken into account as part of the deductions. 198 refers to the calculation of net profit. So company falling under a CSR mandate is required to spend at least 2% of the average net profit of the company made in the immediately preceding 3 years in pursuance of its CSR policy. Now let's look at this. This is the most interesting part of the law. What are these activities which are CSR activities? Activities that may be included by companies in their CSR policy. Most vaguely drafted provisions in the sense that may be included. Eradicating extreme hunger and poverty, promotion of education, promoting gender equality and empowering women, reducing child mortality and improving maternal health. These are all fantastic topics, absolutely relevant from overall balanced growth of society. Very critical from anybody's individual's perspective or corporate perspective that I may have my co-brother and co-human also, surviving in terms of growing across. But how would you define it in terms of actual spending? How would you say that this particular thing has eradicated extreme hunger and poverty? On a lighter side, this first point itself collapses after yesterday because food security bill is supposed to eradicate this only. So if the national food legislation has eradicated extreme hunger and poverty in one stroke, this item number 1 may not be a relevant point as far as companies are concerned. But then promotion of education is something which you can probably implement. Schools nearby, you could always do that. Gender equality. They could have even covered healthcare instead of saying AIDS and malaria and other diseases. Healthcare is one critical thing where corporates can easily cooperate. A lot of villages and rural areas where they're struggling with without facility of hospitals. General healthcare is something which they can simply incorporate. Ensuring environmental sustainability, another generic term. Employment enhancing vocational schools, the skill. This is a very significant thing which companies can actually use it for their benefit also, because as a CSR initiative, if they're able to develop a talent pool, like CII has got significant initiative in skill development. Something similar if somebody is going to structure within their core area, then that is going to come back as backward integration and help the same business for its own growth. And if you can't do any of these things, there is always a fund available called as Prime Minister's National Relief Fund, or any other fund set up by the central government or state governments for socio-economic development and funds for the welfare of scheduled castes, scheduled tribes, etc. You can always contribute money to them in case you are not able to spend this. So this is almost like this, in income tax you have this charitable trust. All these charitable trusts, when they have income, they're supposed to spend mandatorily on charitable activities. And if they're not able to spend it, they can at least donate it to some other trust which is engaged in some other activity. So in the end of the year, if they're not able to actually spend it, they'll start donating to such trust activities. So this is something like that. If you cannot identify your own projects, then you can always contribute to the National Relief Fund. And of course, such other matters as may be prescribed, so new ideas can come to the rules. The report of the Board of Directors has to be placed at the general meeting. It has to include the details about the policy developed and implemented by the company on CSR initiatives taken during the year. And while preparing the P&L, a company shall disclose by way of notes additional information about the expenditure incurred on CSR activities. Now let's look at the plus of the CSR. Definitely it is a focus on skill related activities and talent pool if you are able to tap it. And if you are able to remove poverty related problems around your area or in your neighborhood, the amount of goodwill which it can create is phenomenal. So that goodwill will definitely work for the company. And your current spending on charitable activities or social activities will easily fit into CSR, provided you say that I fall into Schedule 7. Some of these items can actually match the Schedule 7 requirement. So that is as far as the advantages are concerned. Let's look at the disadvantage of CSR. It has an impact on profit. Definitely an impact on profit because you're mandatorily required to pull out some funds out of it. And calculation pains. Almost like your math calculation, you have to take the profit and then do plus and minus and all sort of calculation you have to do for calculating this amount and then take an average. Additional compliance cost. If you're going to spend on poverty, some specific health project or some school related, you will have to create a small group of people who monitor that particular project, ensure that the money is carefully spent on that project, ensure that there is no misappropriation in the way the money is channeled to that organization. So who receives that must be also a bona fide organization. You should not get caught in a trap where you're in a fraudulent situation. By 31st March, you have to make some spend, you run and find out some organization, but that organization is not a very bona fide organization. So all sort of other collateral damages can follow. End-use misappropriation versus increase in cost due to constant monitoring is a question which you always have to address. Now let's look at CSR around the world. Countries like Sweden, Norway, Netherlands, France, and Australia mandated CSR reporting only. They only said, you have your own policy, your initiative, just tell us what you're doing. India has walked the extra mile and legislated mandatory CSR activities as well as reporting. India looks like to be the first country to mandate CSR through legislation. So, we always like to be the first in many things. So CSR is probably one of the most interesting initiatives which Indian law has taken, whereby mandatory spending has been brought. Of course, this is the first step, and it is very likely that the law will develop further when CSR spend does not happen. So there could be, apart from a note in the balance sheet, there could be further penal provisions which could come in over a period of time, depending on how the corporates look at CSR in terms of implementation. Nothing wrong in community development, but community development is already happening out of the heart. But there is always a feel that taxes buy civilization. So when you pay so much of taxes, income tax, excise, CST, VAT, service tax, customs, entry tax, apart from various fees and levies, are these not required to contribute to the welfare of the state? Why should there be another mandatory spend? Is there any logical question because profit earning is not a crime. After all, you are a for-profit organization. Questions. What sort of explanations can be given in case the company does not spend on CSR? Because they say you have to give an explanation to why you have not spent on CSR. My managing director felt that this, he's not very happy with the spending. Can you give such an explanation? You have to give some, logical explanation. So that sort of explanation is not coming. Are not the activities set out in Schedule 7 very general and vague in nature? Extremely vague. Eradicating extreme hunger and poverty is a very, very generic term. What happens if there is a social cost which does not fit into Schedule 7? For example, it could be a very viable project, a fantastic project, but assuming the law takes a view that it doesn't fall under Schedule 7, even though you might have spent it, you may still be asked to spend. What is the scope of the term included in Schedule 7? Can training be promotion of education? That can also become a question because promotion of education is very general. Can the mandatory requirement of CSR be considered as a tax? Mandatory 2% is spent on social welfare through law. Can it be seen as a tax on profits? And if so, can it be a Companies Act? It can raise constitutional issues. Indirectly, does it increase the corporate rate? Yes, indirectly it does touch upon the corporate rate. So these are some of the thoughts which I have as far as CSR is concerned. And earlier speaker has already covered elaborately on audit and accounts. I think the floor can be opened up for questions. And I'm sure they have raised a lot of questions, sir.
These are the questions.
Come here, sir. I think it's your domain.
It's a mix. One about that product that holding company can make
2 layers. The one question before that.
This is a question of mallocation. What are the exceptions of date? The one is more than 2 layers is if it's a non-investment company. If it's a non-investment company,